And this way, if I say something, it'll...
Good evening, and welcome to Money Matters. My name is Pat Welde with Merrill Lynch. With me tonight is Patricia Dunn, also with Merrill Lynch, and Mark Mulholland from the Matthew 25 Fund.
Thanks, Pat.
We're looking forward to a very good show here tonight, where we're really just going to have lots of chat, and you'll hear varying opinions about what's happening in the world of finance, stocks and bonds. So let me actually start with the three of us. I'll start with you, Mark. Why don't you talk about what is your market outlook?
Well, I just actually did our letter to shareholders, and part of what I talked about was, you had to expect I was thinking 3 to 5 years. The next 3 to 5 years are going to be what the past 3 to 5 years were. I mean, we came out of a extreme deep undervaluation, high fear factor, which isn't gone yet. But if you look at where we are in the market right now is about 17.5 times current earnings. That is a 60-year average. The 60-year average rate of return from that period going forward is 10.4% a year. So I tell people in my letter, I said, you can expect the market has potential to double in the next, say, 7.5 years. It'll do it with volatility, still profitable, but it's going to be a little different game than the past 5 years.
Okay, well, we'll come back to some of that. And Patricia, I know you have a very much of a planning-based business here at Merrill Lynch, as I do. But what are you talking to clients about as what to expect as you look out for the next year or two?
Actually, I agree with Mark. I am very positive going forward. There is so much in the way of uncertainty right now in the market, and that always breeds good markets. But the demographics are also there, because these dropping oil prices that we're dealing with because of all this development of our shale is really going to be a game changer for the United States. And at the same time, the technology advances with these printers that actually make things. I see us entering into a whole new era that's going to lead to tremendous growth. And that growth is going to be reflected, I believe, in the stock market.
Terrific. Yeah, there's several things that you said, and you as well, Mark, we'll come back to in the course of our conversation. The first thing I want to do is remind our viewers that our program is taped. So, some of the things you hear, you don't know when we're saying these things. So make sure before you take any action on anything we talk about, please talk to your advisors before you do that. So I want to go back to one of the things you mentioned, because recently we've seen some more volatility than we have in the past, in the last few months, quite frankly. And very recently, a lot of that volatility is coming from, as you mentioned, lower oil prices. Oil prices have dropped a lot as of our viewing, and it's a tape program, but oil prices have dropped more than 40%. And, there's a tug of war going on, and I'll share with you some of the tug of war. But the tug of war is that great news? Is it bad news? Is it, so let's start with Mark, actually. Is lower oil, is that good for the market or bad for the market?
Absolutely. It is an unadulterated good. There's very few things that you could say are positive 99%. There's always unintended consequences.
Sure.
The fact that they can find any really unintended consequences for this is so marginal to the market, it amazes me. I had a conversation on the ride over with one of our shareholders, and he was going with a theory if it just stabilizes, it bounces back up, it'd be good. And I'd be like, how's higher oil prices good? I mean, I really think $25 a barrel is going to be a boom for the world, especially poorer countries, let alone our country.
Right.
The only negative would be the percentage of the S&P or companies that are, E&P companies, exploration and development. The big oil companies will get hurt. Country-wise, I mean, you can list the countries. Show me a benevolent country besides us that has deep oil reserves.
Right.
Let them be crippled by this. I mean, Russia has been terrible for the world economy the last few years. Take away some of their influence by cutting, the oil prices. So this thing, I find an absolute windfall for the market. In fact, even how I always say, we're a little bit before we were talking, we're saying you can have opinions but show money. I've put more money into the market the last 3 days than I probably did in any other 3-day period because the market has declined on these
bad reasons.
On bad reasons, and from everything else, I look at the leading indicators are positive. There's no sign of recession. The World Bank just raised our GDP from 3.1 to 3.5 purely from oil declining, and yet the market's pulled back. So,
Patricia, do you agree?
I absolutely agree, because when these oil prices go down, consumer spending goes up.
Right.
And we are a consumer spending driven economy. So I wouldn't be at all surprised if Christmas sales this year are up versus last year.
Terrific. I'm not disagreeing. I'm just going to give you the other
Give the
side
other
of that
side, fair
argument
enough.
because in the last week, 6 different Wall Street analysts who drive firms and drive research have lowered their earnings for next year on the Standard & Poor's 500 because Exxon, as an example, will earn less money next year than this year, so that's going to decrease the earnings. Now, you always talk about price to earnings multiple.
Absolutely.
So if the earnings per these analysts are going to decline, that would lead the PE to be higher next year than, and that's not normal. Normally we're expecting positive growth in earnings, which we still are, but if that's going to be a declining number, that's not a good thing.
Okay. The analysts are wrong. Simple as that. If
As
you
many
look-
times they are.
Yeah, they don't really. And here's like the reality of it too. And this is all built in. Like analysts are important to the market as a group. Individually, like if you ever even follow an analyst, I even say this like for brokers or for individuals, you literally have to do research on an analyst. You have to find out, are they momentum driven?
Right.
Are they growth driven? Are they value driven? So when arbitrarily 1 or 2 out of hundreds of analysts lower earnings, what's their motivation? They could be pure momentum guys. The markets come down, it must mean they're going to have lower earnings, and they extrapolate. So they don't come to it objectively.
Reactive.
But what you can
Right.
use, I do use consensus earnings, because as a group, they value. So these are current, these are as of yesterday.
Mm-hmm.
The estimated earnings for next year on the S&P 500 2015 is 132.80. That's already lower than it was a few weeks ago. So yes, these people are in there, but still at that level, that only puts us around 15.5 times next year's earnings. There's, it's still a 13.5% expected growth over
Right.
next year. So does it affect Exxon? Did they lower from what that particular analyst? Sure. But does it help FedEx,
Exactly.
Boeing,
Right.
Delta? Yeah,
A lot of
plenty
brown
companies.
trucks out there.
There's
so it might be
more
good for
companies in
UPS.
the transportation index than there are in the energy index. And the energy index actually includes utilities, which is a little bit of a, not really logical.
Right.
Do you know what I'm saying? Like it's really, it's going to affect some companies. There's no question.
Right.
But they're a small percentage. It's going to help 90%. It's going to hurt maybe 5 to 10%.
Yeah, I would tell you, and again, I'm not disagreeing at all with that. I mean, there's plenty of positives for lower energy, for sure. I think the real question that none of us today can answer, but ultimately will be answered, is why has it dropped 40%? It doesn't just drop because it drops. If it drops, and I'm not saying this is accurate, if it drops because of demand, well, that's not good, and that's foretelling of some bad things out there. It's not always right, but I think we need to dig in and really kind of pay attention to why is it dropping.
I think it's dropping because of supply. Supply is increasing.
That's measurable, and
Yeah.
it is, but it's not increasing by 40%. It's increasing by about 2%. So it is increasing, but that does not that should not account for a 40% decline in a barrel of oil.
No, but here's the thing that's tough. What's the fair price of, say, gold?
Who
You
knows?
tell me.
Yeah.
You tell me.
What's the fair price of oil?
Yeah. You tell me.
It's actually easier to determine on oil than it is for gold, because there is like a use to it, it gets consumed,
Right.
and there is like a cost of
Cost
producing
of
and stuff like
production.
that.
All right.
Sure.
But commodities are the hardest thing to really evaluate, and why they swing so much. Do you know what I'm saying? You can never figure out. And what happens, it's that same thing which I mentioned about analysts. Oil could be down, no question, from what Patricia said about the supply. I was
Right.
amazed oil hadn't come down earlier, but then it comes like in this concentrated move. That's just how the market works.
Right.
Because to some degree, maybe oil going from 90 to 75 was on fundamentals. From 75 to 65, it might just be purely momentum players.
Sure.
And Wall Street, one thing I laughed, I was actually looking at Goldman's predictions for next year, and they keep saying this, less volatility. They were saying at the beginning of the year, they've gotten their volatility, and Wall Street loves volatility. I don't know why, they can't just buy something and sit with it, but
Right.
they seem to need to have activity. So be careful. That's what the news will do, is they always are looking for cause and effect.
Right.
You know?
It's never that simple.
It's never that simple. There's always, now the one thing which I thought you were heading toward is there could be other factors. There could be the one negative you can get from this would be oil demand's going down because it's reflecting decline in the economy. But it's not showing up in the leading indicators.
Exactly.
Right.
And there hasn't been, if you look at, I have the data here, so it's hard to show on here, but the last 2 recessions, the leading indicators declined 3 months prior. And we're 17 months in a row up. It's really not showing yet. Could there be something out there that we don't know? Yes, but the probability of that's only 5%. really having a negative
I think
effect.
we're in agreement, the three of us, even though I gave the other side of the story, just to make sure it's a full
Socratic
slated
approach.
slow.
We're giving both sides.
We are very all optimistic about the market, as I am too, quite frankly. But the market's a big place, so let me start with Patricia. What are you finding attractive in the market? I mean, obviously stocks. I like the stock market. Well, it's got to be things in the stock market that you like, or types of portfolios that you like. What kind of portfolios are you building?
The portfolios I'm building right now fall into two categories. I'm looking primarily at stocks that are showing a pattern of increasing earnings estimates. And I follow a strict discipline there. As long as they're increasing their estimates, I'll keep holding the stock or buying the stock. When they cut their earnings estimates, the analysts, that's when I sell the stock.
Okay.
The other group is on the more conservative end of the spectrum, and there I'm still concentrating heavily in both high-quality dividend yield stocks and also ETF strategies that are broad-based, particularly the ones that are aggressive. Because I'm very
ETF for our viewers
positive.
are exchange-traded funds.
Correct. I'm sorry, yes. Exchange-traded funds. And I follow aggressive strategies there because I am very positive on the next 3 to 5 years.
Now, Patricia, can I ask you a question that ties into Pat, what he had asked? On the when estimates decline, like obviously they must be declining on energy-related stocks. Would that make you sell those type of stocks, or just hold on to them and wait a while? Or
No,
what's
I
your
would
strategy?
sell them,
Okay.
and I would go with the stocks that are increasing their earnings estimates, which could be as a result of the drop in the price of oil.
That's fine.
Other industries are doing better.
Okay, that's fair. So you would like that's more of like in my world I would consider that more of a growth strategy.
Definitely.
You're not a
It's growth.
value-based person,
No.
whereas like a value-based person might be lurking, we call it sometimes like vulture investing, might be lurking around in the energy patch to try to find some opportunities. But
Right.
you're going to go more with what's working
Right
now
now.
and coming up. Okay, fair enough. And we were going to ask you, Pat.
What do you find attractive, Mark?
This will tie in a bit to what Patricia said when she was talking about it. I happen to think the retail stocks are attractive. They've gotten beaten up lately. Our second biggest holding in a fund is a company called Cabela's, which is a very unique retailer because they one of the things people always worry about is like the idea of bricks or clicks, where you kind of
Right.
like they're the number one catalog in this kind of
It's
hunting.
Disneyland
fishing.
for the outdoors person, isn't
Right,
it?
right.
I actually have a Cabela's card just
Sure.
at the store, and I'm not
It's
even a hunter or
Disneyland
fisherman.
to those
It's a
folks.
wonderful store,
Sure.
but they hit you in all three ways. And the stock actually is off this year. It had a great run last year. It's off this year because of like kind of what Patricia's talking about when you do these comparisons. They were getting great gun sales and ammo and stuff like that. The numbers relative to this year were up, but not as up strongly. And there were some things that came off. But the company, if you really look at longer term, which I try to do, they have a built-in growth program. They're going to add roughly 15% new stores per year for the next 3 years. Already planned, zone, under construction, some of them. That, and also when they get their comparative numbers pick up again, which they were really strong the prior 3 years. I just look at, and the valuation's great. The company's only about 6 times EBITDA. Okay. So we've owned that for quite a few years. We have a nice profit in it. But I've been adding to it because I think it has a lot of potential because there's a little, and it ties into what Patricia was saying about the energy. One of the things that hurts Cabela's is they only have 53 stores in the whole country, United States, a couple in Canada. Right. You have to drive to their stores, their destination places. Well, lower oil helps them. So I'm optimistic there.
I'm actually going to plug for our viewers who actually is Mark Mulholland. Many of you have seen him on this program before. We've worked together several times together. But the Matthew 25 Mutual Fund, I'd ask you to do some due diligence on your own. But New York Times just put out a Sunday business article where they reviewed funds for performance for the last 5 years. And Mark's fund did rank first in the last 5 years for performance. So check out the Matthew 25 fund. I always like to throw in, we've talked about the stock market, but one of the reasons that I'm most optimistic about the stock market is that other market that's out there, which is way bigger than the stock market, and that's the bond market. Patricia, what are your thoughts on the bond market? And I'll start by telling you, my optimism in the stock market is going back to, compared to what versus what. And when you're putting together those dividend portfolios and you can put together a 10 or 20 stock portfolio, truly, that people would be proud to own. If they looked at their statement and say, I own this, you're going to be proud to own these great companies. And the dividend yield on those companies today is going to be higher than the yield on the 10-year Treasury.
They're
It makes no sense to me.
It's knocking up against the 30-year Treasury. And
Yeah.
when you think in terms of our discussion here that we see positive things for the market in the next 3 to 5 years,
Right.
why would you buy bonds in this environment?
Yeah.
At the same time, bonds are very simple animals. They only do 3 things. Interest rates either go up, they go down, or they stay the same.
Sure.
In our collective experience, we have seen 30 years of declining interest rates. Past 5, they've been flat.
Right.
Where do they go from here?
Yeah.
There's only one option left. And when interest rates start to rise, bond prices decline. It's an inverse relationship.
Yeah.
So my attitude is the best way to avoid a punch is not be there. So I am not a big fan of bonds in this environment.
Very good. Mark, I know you're a stock guy, but obviously you compete against the bond world. What are your thoughts about where interest rates are and how easy or hard that makes your job?
Yeah, I actually that same data I mentioned a few minutes ago, that the 60-year average PE is 17.4. We're like 17.5. But when you look at that, that's the offset to that was what could you get in bonds? Well, during that same 60-year period, the average rate on corporate bonds, long-term corporate bonds, was around 6.4. We're now 3.8,
Yeah.
something like that. And here's the thing which I do think, I'm not really per se competing against bond funds. I guess indirectly they take money away from the whole pool and stuff like that.
Right.
But like you guys would know better. You're dealing with individuals. What would say a 20 or 25-year municipal bond pay today? Like a good quality bond?
3.5%.
Yeah.
Okay. That wouldn't be an easy sale to get someone to buy
No.
a 25-year.
No.
Absolutely not.
Yet the same person would turn around and go to Vanguard, not to pick on them, but just a logical
Let's pick
choice,
on 'em.
and buy a bond fund
Sure.
that
Right.
has 25-year maturity and earn less, because even though Vanguard does it cheaply, they still take a quarter a point or 15, whatever they take, basis points.
Right.
It reduces your return. So if people won't buy individually a particular, or look at, like I was looking at the rates on treasuries, a 20-year treasury note right now is 2.87.
Yeah.
I can't picture anyone tying up their money. Like, you're basically making a loan to the government at 2.87%.
I've said on this program more than once, I'm going to say it again, I want to meet these people buying that. I really want to sit in a room with them and have a beer and just talk. Why are you buying this? I mean, do you realize you're buying something that's paying 2.8%? You're going to pay taxes on that, and there's inflation. So, I mean, somebody who's buying that is knowingly and willingly
Setting themselves
losing purchasing power.
Well, and that's the thing, like Patricia said, bonds are cut and dry.
Yeah.
There's not many variables to them like there is with a company.
Yeah.
It's basically maturity, quality, and interest rate.
Right.
And they're not, a government bond, a 20-year government bond at 2.87, all things being equal, you can expect 2.87 for 20-year return. That's terrible.
Yeah, I agree.
So what happens is people are buying them because they're looking at trailing records. And, it's funny, they say it ad nauseum about mutual funds, past performance is but for bond funds, it is so clear.
Oh, my goodness.
It has an inverse relationship that if they've done double digits for the last several years, and long run bonds should do in the mid digits, in the 5 to 6% range, you're gonna have to work it off at some point. And I think a lot of people are
That
gonna
day
get hit
is
by
coming.
that. Yeah.
Well, I have a viewer question for both of you, actually. I have a question from Ralph Donalds of Malvern, who asks, and this will tie into what we talked about earlier, could you give me some other investment relationships, like oil goes down, then the airline stocks go up? What else, what other relationships are there?
Go ahead, Patricia. I thought
Well, yeah, I said it earlier that when oil prices go down, gasoline prices go down, consumer spending goes up.
Right.
Because the average person has more money to spend. And I think we're going to see these results in the next couple of months. But another relationship that we've discussed is that when interest rates go up, bond values go down.
Yep.
You could take it further and say when taxes go up, the economy goes down, and there's less job creation. Conversely, when taxes go down, the economy improves and more jobs are created.
And I think what Patricia was saying is the oil and gas prices going down is like a tax cut.
Yes.
Without question, it's going to be stimulating to the economy. So, yeah, I think it's. I understand like there's a direct correlation that the fellow, the question had asked about airline stocks, and there's truth to that, even though I think that's a tough industry generally, you know.
No, it is.
But transportation stocks will do well. One of our holdings is FedEx, you know, that falls in the index, but it's not like in the same business as the airlines per se.
Right.
They'll do wonderful. But I would be willing to say that oil prices going down will benefit the majority of companies, if not 3/4, if you think of the whole market as a whole, because of, you know, consumer spending. It's got to be it's somewhere around 70% of the total GDP, and all our consumers have more money in their pocket. I just filled up my daughter's minivan, and
It's amazing, isn't it?
so I probably saved 25%. You know,
And we're not
that
there
adds
yet.
up.
And when you think about it, every industry has logistics, manufacturing. You know, just go right down the line. They have to have raw materials delivered. So a drop in oil prices benefits multiple companies.
Patricia, remind me of something. You had said something earlier, which I thought was great. You talked about like the 3D printing, the things that have advanced in technology, just the benefits we get from the handheld, you know, iPhones and things. You know, just things are getting so much better for manufacturing. You know, where everyone always worried about manufacturing in the United States declining. It's been on a bit of a renaissance. It's going to have more to come because lower energy consistently helps them, both on logistics and in manufacturing in most cases. Just heating your plants, you know, it's going to make a difference. So there's a lot to come, I think.
Well, Ralph, I hope that was helpful. You know, viewers, we do like to receive your questions and hopefully get you the answers that you need and deserve. Here's how you can go about sending questions to us.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our hosts and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, M-O-N-E-Y, -matters, M-A-T-T-E-R-S, TV.com.
Thank you again, Ralph. I'm often asked by clients what would make me less optimistic, and my answer to that, with experience on my side, and I know, Pat, you have more experience than me, and you have a little more than me, is investor sentiment. And the way I'll define that is, I talk to clients all day, every day, real people with real money, with real concerns. And Pat touched on it earlier that, today there's plenty of reasons for scared people to be scared.
Yeah.
There's more reasons than I can shake a stick at, quite frankly. Even recently, and I don't want to sound insensitive, but the fact that the market cratered very recently because of Ebola, that's silly. It really was silly, quite in my opinion.
It was.
Now, but the people are looking for a reason to be scared. So sentiment is still quite low, and there are very different types of measurements of sentiment. Our firm has one that's very dependable, but we have a better one, I think, by just talking to real people. And I said to Mark earlier, when it's easy for me to sell stocks to people, to clients, to real people, and when I call 10 people and 10 of them say yes, and then not only 10, they say, you know what, my next door neighbor wants to talk to you too, that's when I'll get more nervous. That's when I'll get more, maybe we're at the end of a run here. We're far from that. Do you find the same thing talking to real clients? That
Absolutely.
It's not easy? And
Absolutely.
they're very, very scared still.
They are, and particularly in prospective clients who are referred to us.
Right.
And we had that initial conversation. They go, yeah, so-and-so speaks very highly of you, but I think the market's at a high and it's going to pull back, and I'm going to wait for the pullback and then let's talk.
Yeah.
And I just say, this is great. Yeah. As long as we keep hearing this market's going higher.
Mark, I know you have some data on this.
Yeah, I do. You ever seen like in economics, they always say like one of the jokes is a recession's when your neighbor's out of work, a depression's when you're out of work.
Yes.
Well, what you're talking about is very personal and it's good. Like now I can give like the big picture data which supports what you're seeing.
Right.
If you look at the, one of the things I follow is from ICI, it's the mutual fund flows. It shows where money's going. And to me it shows what people are thinking or what they're doing. the data is remarkable. Like prior to 2006 and 2007, the longest period we had of outflows in U.S. stock funds was 3 years. And that ended like in 81 or 82. I forget the exact year. The 6 years ending in 2012, 618 billion came out of domestic equity funds. So I understand going into it, like 06, 07, 08 made sense. But 9, 10, 11, 12, they still had outflows. It was remarkable. Last year was the first year with inflows. 18 billion came in.
Peanuts.
Nothing, 3%.
Right.
42 billion has gone out this year. And at the same time, last year was the first outflow for bond funds, but almost the exact same amount has gone into bond funds still. So it's one of the things, it's hard to really say. I even think like you have the advantage of, and Patricia does too, where you're talking to clients and you're getting like kind of like almost like the effect of a survey just by your natural activity.
Every day. Yeah.
But even the average person, think of it, remember years ago you would hear people quit their job to day trade or something like that.
Yeah.
That's for the average person.
My favorite commercial, well, I got to give them credit, and I apologize, I don't know who it was, but when you saw the truck driver, that big heavy-set truck driver riding down, and he had a picture of his island on his dashboard.
That's right.
What is that? That's my island. He was day trading.
Well, the thing is, that's how like the average person, like a person who's not in the business, can probably like you can start seeing smoke signals, like to be careful.
Yes.
When I look at the ICI data and I tell people, so 630, 640, or almost 650 billion has come out. I'm not going to really worry about the market until I see 300 plus come in. Now, if it comes in 1 billion,
right?
If it comes in 1 year, I might get a little more nervous than normal.
Yeah.
If it comes in over 5 years, I'm not even going to worry because we'll have enough growth to support it and things like this. So there's more to come to this. I know it. It doesn't mean there's not going to be pullbacks and there's not going to be Ebola scares or oil scares, but it's going to occur. But it's still a great opportunity.
Well, it's healthy, quite frankly. I mean, this is, I'm amazed at when people get nervous. We've had a heck of a run. Let's be fair. I mean, let's be honest. We've made a lot of money in the last 5 years, 6 years. So when we have a 2 or a 3% correction, and the phone starts ringing, and is this it? Are we? I like, no, because you called. It's not it.
I have a great statistic for you. Since 1900, the average number of corrections of 5% or more per year. What would you expect?
3.
You got it. 3 per year. Right on.
Yeah.
It corrects that. That is so frequent. Yeah. But every time they come in, now I think part of what it is CNBC and Kramer. And, they're bigger than Wall Street Journal ever was. Yeah. And it's just Fox Business News, Bloomberg News. It's just they overanalyze it, and it's just
they have something to talk about.
The market
it's hype.
This was a great program. Hype. We could go on for another half hour, but the producer won't let us.
Fair enough.
So, our next guest is Mr. Jim Harris, who's the CEO of Polycore Therapeutics, who runs a very interesting gentleman. He's going to talk to you about his biotech company, actually companies, because there's more than one company that he represents. So, as always, your money matters. Stay optimistic.
That's great. Thanks.